What if the money in your pocket is designed to lose value? What if every dollar, every rupee, every euro you earn is secretly being siphoned away, not by thieves or hackers, but by the very institutions meant to protect it? Because inflation isn't an accident, it's not a natural disaster, it's a mechanism, a silent tax, created, maintained, and weaponized by central banks. This is the story of how inflation became the perfect tool for control, how governments learned to tax without laws, and how central banks turned money itself into the instrument of your dependence. To understand how inflation became a system, we need to go back to the birth of modern central banking. It began in 1694 with the creation of the Bank of England. Britain was deep in debt after war, desperate for funds. Private financiers proposed a solution. They would lend the government money in exchange for the right to issue banknotes, promises to pay gold on demand. For the first time, money was no longer just metal. It was debt. And whoever controlled the creation of that debt controlled the economy. This idea spread fast. By the 19th century, most major nations had their own central banks, acting as lenders of last resort, but also as gatekeepers of money creation. And then came the United States. In 1913, a secret meeting on Jekyll Island gave birth to the Federal Reserve, a private network of bankers given public power to control the nation's money supply. Their stated mission was stability. Their true power was creation. They could expand or contract money at will, a power that would soon reshape the world. For centuries, money had been tied to gold. That link kept governments in check. They could only spend what their gold reserves allowed. But wars are expensive, empires need flexibility, and gold, it turned out, was inconvenient for control. In 1944, after World War II, the world gathered in Bretton Woods, New Hampshire. There, the U.S. dollar became the world's reserve currency, backed by gold, while every other currency was pegged to the dollar. It seemed stable, but behind the curtain, debt was growing. Governments discovered they could print more money than they had gold, as long as people still believed in the system. By 1971, the illusion broke. President Richard Nixon severed the final link between money and gold. Overnight, the dollar became pure fiat, a currency backed by nothing but government decree. And from that moment, inflation was no longer a risk. It became policy. Central banks could now create money without restraint to fund wars, bailouts, and political promises, while citizens paid the hidden price, the steady erosion of their purchasing power. Once the dollar was unanchored, inflation became inevitable. But something more profound happened. Governments learned to use it. Here's how it works. When central banks print new money, that money doesn't go to you first. It enters the system through banks, corporations, and governments, the elite who spend it before prices rise. By the time it reaches you, the value has already been diluted. You work harder, your paycheck grows in numbers, but what it buys shrinks. That's not bad luck. That's monetary design. Economist John Maynard Keynes once wrote, "There is no subtler, no surer means of overturning the existing basis of society than to debauch the currency." Because inflation doesn't just raise prices, it transfers wealth, from savers to borrowers, from workers to asset owners, from the public to the few who control the flow of money. Every time the printing press runs, your savings lose power. Your labor buys less and the system grows stronger. Inflation is not a symptom of failure. It's the engine of the modern economy. The 1970s made it clear. Oil prices skyrocketed. Inflation raged. Central banks tried to fight it by raising interest rates, causing recessions that wiped out millions of jobs. But instead of reforming the system, they doubled down. In the 1980s and 1990s, cheap credit became the cure for every crisis. Markets crashed, print more, debt too high, lower the rates. Growth slowing, stimulate the economy. Every fix created a new bubble, and every bubble required a bigger rescue. By the 2008 financial crisis, central banks had crossed a line. They printed trillions of dollars, bought toxic assets, and bailed out the very institutions that caused the collapse. It was the ultimate trick: socialize the losses, privatize the profits. And who paid for it? You did. Through inflation. Because when trillions of new dollars enter the economy, the value of every existing dollar falls. Prices rise, wages lag, and the gap between rich and poor widens even further. It's not theft in the traditional sense. It's something smarter, quieter, more permanent. Central banks claim they target 2% inflation. They call it healthy for the economy. But ask yourself, healthy for whom? At 2% inflation, your money loses half its value in about 35 years. That means a lifetime of work is silently eroded by design. Why would they want that? Because inflation does what taxes can't. It reduces the real value of government debt. It forces people to spend instead of save. And it keeps the system running by ensuring that money always flows upward, never stagnating in the hands of the public. Deflation, falling prices, would actually empower savers. It would give workers stronger purchasing power, but to central banks, that's dangerous, because when people hold their money, they hold their power. Inflation ensures the opposite. You can't afford to stop. You must keep spending, borrowing, and chasing the rising tide. That's how inflation became the perfect invisible tax. No law, no debate. Just the quiet theft of time, labor, and wealth, hidden behind economic jargon. Today, we're living through the next great inflationary cycle. After the global pandemic, central banks printed over $25 trillion worldwide. The result? A cost of living crisis in nearly every country. Groceries, housing, healthcare, everything climbing faster than wages. And yet the official narrative remains the same. This is temporary. It's under control. It's necessary for growth. But history disagrees. The Weimar Republic, the 1970s US, Zimbabwe, Argentina, Turkey. Each suffered from the same pattern. Governments printed to solve debt, and inflation became uncontrollable. Every empire has learned the same lesson. Once money becomes limitless, value becomes meaningless. And the final stage of inflation is always the same: loss of trust. Takeaway 1. Inflation is not just an economic issue, it's a political tool. It allows governments to spend without accountability, and it shifts the burden of debt onto citizens who don't understand the system. Takeaway 2. The real victims of inflation are savers, workers, and pensioners. While asset owners see their wealth grow, the middle class is quietly drained, year after year. Takeaway 3. The illusion of growth hides a truth: that prosperity built on debt is not prosperity at all. The silent tax of inflation may not show up on your paycheck, but it's there, in every higher rent, every shrinking grocery bill, every dream delayed because prices moved faster than wages. And the system isn't stopping. The next chapter is already being written. Central bank digital currencies, programmable money that could make inflation not just invisible, but automated. So what can you do? Learn the system, understand how money works, and remember, real wealth is not how much you have in numbers, but how much your time and freedom are worth. Because once you see inflation for what it really is, a mechanism of control, you'll never look at money the same way again. If this video opened your eyes, share it. The more people understand how money truly works, the harder it becomes to use it against them. Subscribe for more deep dives into the hidden architecture of money, power, and control. Because the first step to escaping the system is realizing you're living inside one.